Wondering what you can do to save some tax before the 5th of April? Well, watch on. As a business accountant, my team and I spend all day long helping business owners on their journey. And as we move towards the end of the personal tax year, which in the UK runs from the 6th of April one year to the 5th of April the next, there's a bit of a scramble to do some last minute tax savings. So what I want to talk to you about in this video is just a few things that you might want to investigate, see if it's right for you, and then you might want to take some action over the next kind of month. If by the time we release this, it's probably mid-March, something like that. So there's a few weeks to go. And if you're watching this at another point in the year, it's still relevant because you can just do it earlier. You don't have to scramble around, but it's always a good reminder about this time of year. So let's go on with it. Now, what you can do is there's a few things. Firstly, I'm going to talk mainly about business owners. So the first one particularly is very relevant to business owners, but a lot of these things will just apply to UK individuals, UK taxpayers as a whole. Now, massive caveat at the beginning of this, which really applies to all the videos here, is that some of this stuff is so specific to your individual circumstances that it might not be right for you. So do go and seek out professional advice before doing any of this. If you want to be sure of what you're doing, don't just take some random guy's opinion on the internet about it. And also some of it can be like you could do it, but it might not actually make any difference. And there's a few of those that we'll get into. So firstly though, let's talk about your business. So whether you're a limited company or a business owner like a sole trader, although your limited company will have a tax year that's probably different, not always, but it can be different to the personal tax year. Some of this advice kind of applies anyway, but for a lot of people, they will align their limited company year with the personal tax year end. So you might find your limited company year is the 31st of March. Now, if that's you, this definitely applies to this kind of period, this scramble before the 5th of April type affair. But if not, actually, it still works before your year end. But let's just talk for now, though, to keep it simple. Let's think you're a sole trader, you're coming towards the end of your tax year. What can you do to save tax in your business? Well, the first one is think about your investment in equipment and big stuff, really. Like you might want to refresh your laptop, or you might want to invest in some new camera gear. Doing that just before the end of your financial year, or the tax year in this case, is a really good idea, because if you imagine the line's going to be drawn at the 5th of April, your tax bill gets calculated. So in order to affect your next tax bill, if you reduce your profits by investing some money in some equipment you were going to need anyway, then your profits are going to be lower, your tax bill is going to be lower. So you're affecting your next tax bill, and that's the big one. It's always like the worst, saddest thing to do is buy a load of stuff on like the 6th, 7th of April, because your tax bill, your line's drawn, you're going to be paying your tax bill, and then you start to spend money that you won't see the benefit on your tax bill until like the whole time next year. Like it's quite a long time away. So just make sure, if you're thinking of spending some money, maybe consider bringing it forward. Now, we've done loads of videos on tax deductions, how that works, whether it's a good idea to spend money just to save tax. But in brief, just think about, am I going to be spending money anyway in the next few months? Maybe let's bring it forward. Sometimes, depending on how you do your books and that, it's not like you should just go out and buy loads of stock, because generally for a lot of people that won't make any difference. We're talking really about equipment, think like laptops, IT equipment. I know like in our business, we'll always be thinking just before our company year end, what IT equipment do we need in the next 3-4 months? Let's have a look at it. And as we're recording this video in the beginning of 2023, if you're a limited company, this kind of tactic strategy still works for you before the end of your tax year. But the 31st of March is still really important, because there's something called the super deduction that's available only to limited companies that gives you 130% tax relief on new equipment. So it's still really a good time for your limited company as well if you want to invest in equipment. That's going away, as far as we know at the time recording this video, at the end of March. So whether you're a limited company or a sole trader, just think, if I'm buying that big stuff, that equipment, investing in new stuff in the next few months, think about bringing it forward. Now, while we're talking of big stuff, and oddly, I always think of it as big stuff, there's this thing called capital gains tax, right? And it's there for a tax on traditionally something like selling your residential, not your residential property, sometimes it applies, but like a residential property that you've been letting out. That's one of the most common scenarios you would see it in. And also if you're disposing, however, of things like shares, and more commonly these days, cryptocurrency, if you're lucky enough to have made a profit on that, then quite often if you made profits, they're going to be taxable under capital gains. Now, you get an allowance every year alongside, so you might know your personal allowance as a UK taxpayer is about 12.5 grand that you can earn tax free. There's a separate allowance for capital gains tax that's 12,300-ish quid, which means that depending on the tax year we're talking about, but let's just talk about now, that means that you can make profits of that before you pay any tax. So what you might do is split the disposals, the sale of those things over a couple of tax years to maximise your allowance in one year and then use your allowance in the next. So if you're thinking of disposing of like a lot of shares, you might think, well, I'm going to sell some before the 5th of April, use my 12 and a bit grand allowance on that, and then I'm going to sell some next year and use my allowance that's available on those ones, and actually that can save you some tax. Now, what's really important in this tax year as we're recording this, so at the end of the 22-23 tax year, is that allowance is being aggressively slashed moving forward. So at the minute it's just over 12 grand, it goes to 6 and then it goes to 3 in the coming tax years. So it's even more important to consider, well, if you're going to be doing it anyway, is now the better time from a tax point of view to do that? So really consider that. Particularly you see people deciding to get rid of crypto things and they might have made some money on it. Like, think about the timing, I guess, of it. It's not a complete win, but it really is something that if you time it right, can be quite good. Like, we see people over the years who have been thinking about, reducing the size of their property portfolio. So they might sell one this tax year, one next, or something like that to really help ease those bills. And there's a bit more planning that goes around that, but I just want to plant that idea in your head that the timing is important. So think about that if you're selling those kind of things under this capital gains rules. So swinging back to business owners, particularly limited company owners, it's quite possible that when you take your money from your company, you're going to have it in two ways. You might have some salary on paper, paid like a normal employee under what they call PAYE, and then you might have some dividends that you take the rest as profit. And that's a pretty normal scenario and has been for many years. You take a bit of a mix of the two. This salary proportion is really important, and we've done other videos on why it's important, why you might want to do it, but start to think about what you're being paid, if any. I've seen literally this week, I've seen one we see probably, I don't know, at least a couple a month, where someone's declared no salary at all and they've actually lost out on a large tax deduction in the company. And then we also see them where they've been declaring salary where it made no sense, they've been paying more national insurance than they needed to. So it's one of those things that's very, very dependent on your situation. But think about, are you paying any salary? If you are paying salary, what level you are paying it at, because you have to pay it at let's just say for ease, 6.5 grand or more. There's a rough figure. There's an exact figure about this every tax year, and it tends to move. But there's around that kind of figure, you tend to get a tick in the box for your state pension as what's known as a qualifying year. But it all needs to come from sort of one source in a single job, and sometimes people don't have it, and then you can lose a qualifying year. So think about that. So your state pension qualifying year, how much are you actually paying any generally, and also with your dividends, things like that. So at the moment, paying a dividend before the 5th of April each year, there's a dividend allowance. That means the first £2,000 of dividends total, not per company, I think total to you as an individual, are free of tax. They're like 0 rate. That's fine. But again, they're aggressively slashing that as the years go on now. So it's sort of halves and halves. So make sure to think about timing. So even if you don't want to take the physical money from your bank, there's always an opportunity to think about, actually, is now a good time to note a dividend and I'll take the money later or something. As long as the paperwork's in place, that's also possible. So salary and dividends, just think, am I using those allowances? Because they are kind of use it or lose it. There's not a chance to really do anything about that. So very important. And payroll is very difficult to backdate. So you don't want to go later down the line and have to think, oh, I didn't declare any of that. Like, what's the deal, and try and fix it. Like, do it. But it is possible to kind of do a whole year's salary in one go from a declaration point of view and things like that. So just investigate those things if you think that's right for you. Something that could be less exciting, depending though on the amount of money you want to contribute, is think about pension contributions. Now, it's one of these things that we can't talk to you too much on YouTube about, because actually pensions advice itself is like this regulated area. It sits with independent financial advisors or financial advisors in general. That's in their realms. We as tax people can tell you about why it might be a good idea for tax, but whether it's a good idea to contribute to a pension in general for your goals, and whether what pension scheme to do, all those kind of things, you want to seek out a financial advisor. But from a tax sense, there can be benefits. If you're making personal contributions to a pot as you as an individual, then you do get like a tax top up in most cases at the pot end, and that sounds pretty good, so you might want to think about that. If you're a higher rate earner, and you're doing that, it's quite often the case that because they only top your pot up with 20% one end, what it means is that you're missing out on some contributions because you're being taxed at 40%. And often, if it's done in a tax return, you might even see a direct tax refund for you for the extra money that should be in your pension pot. So it's definitely worth investigating that. Now, pensions and the way they operate can be fairly complex, so it's not applicable all the time. So, and again, it's going to sound a bit of a broken record, but this is one where you definitely want to get some advice before making any claims to make sure that it actually makes sense. So there's that. But as a limited company owner, quite often what people will do is they won't make individual personal payments because the company would have been taxed. Then you've had to been taxed to get it in your hand as dividends, say, and then you're going to make a tax payment to then get a tax top up. When the numbers are crunched, quite often it's better for the company to make a employer's contribution as your employer, effectively, into your pension pot direct. And there's some practical things that need to happen for that to be the case. But that's quite a good way of reducing your corporation tax and overall tax kind of exposure to make those pension contributions. But again, this one is very dependent on your goals and your circumstances, but that's there. So again, the thing I want to place in your head is, should I be making any pension contributions? I want to, like, is now a good time and how do I do it? Think about those kind of things. And then while we're on the subject of kind of like investments, again, you might have loads of things going on, but just think most UK taxpayers have got £1,000 of interest they can earn tax-free each year, or if you're a higher rate taxpayer, it's £500. So their interest generally, a lot of people don't seem to realise these allowances exist, and then they concentrate on ISAs, which are the tax-free kind of wrapper that you can put your cash into, and there's a limit each year, so it's about 20k at the moment as we're recording this video that you can put into, and then the interest is free. But you might not even necessarily want that if you can already have a higher interest rate somewhere else and your interest is going to be tax-free anyway. Again, there's positives and negatives to this, but just again, the thing I want to put into your head is that you can have some interest tax-free already, so consider that in the overall picture when you're looking at it. But particularly if you've got chunks of money you want to put into ISAs, there's a limit each year, it's time to use it. That's the other option that you've got to go for. And then a couple of quick ones for you to consider. If you're married or in a civil partnership, there's a chance to transfer some of your personal allowance, that's sort of 12.5 grand we were talking about, across to your other half, and that can be quite good in the tax planning scenario. But it's one of those things that's actually not always that great. It's not that commonly used, and it can't be used if one of you is a higher rate taxpayer, because I think everybody would do it then. You know, if one of you was paying higher rate tax and you could transfer your allowance from the one that's not, it would be really cool. That's not allowed, but there can be opportunities. One of you's like quite a low earner and the other one's sort of doing all right, and you're both in the basic rate of tax, and it can be done, it can be backdated. So again, have a little Google on that or check out with an advisor, but think that it's possible to move some of your allowances around if you're married or in a civil partnership. So that's good. While we're talking about families and things, child benefit, it's not a tax as such, and it's not normally taxable income, but if you earn over 50k and it's being paid to your household, there is a good chance that you'll end up having to pay some of it, if not all of it, back. So if you earn between 50 and 60k, you're going to have to pay a staggered amount back. When you reach 60k, you have to pay it all back. And it can be quite a shock. We see it every year. There's lots of people who just still don't know that this is a thing, even though it's been around for a few years now. So if you're getting child benefit and you know one of you's on over 50k, think, I've probably got to do something about reporting this, and think about whether you want to claim it moving forward. That's probably a whole nother video about whether you want to claim it, but there are options. But just know, again, there is this high income benefit charge on child benefit if one of you's over 50k. And then finally, if you've got some cash to kind of burn and you want to distribute it around your family, it's an inheritance tax thing, which I don't talk too much about on this particular YouTube channel, but at the same point, it's worth knowing there's a kind of a gifts allowance every year that you can give. I mean, there's lots of different allowances, and actually it's worth looking that up because there's all these little ones you can do. And the reason the allowances are there is that you can give them sort of inheritance tax free, if you like, because there's like a general clawback rule that if you start giving money to people and then you die within 7 years, there's like a clawback. But is an amount that you can do for lots of different reasons, lots of different allowances allow you to give some money for free to people. So have a look. If I remember as I'm recording this, I'll link in the description a link so you can see some of those allowances. So if you want to do that, that's also a cool way of making sure that you can redistribute some stuff. And again, there are kind of limits. Some of those limits can be drawn into a next tax year, some can't. So yeah, check them out. But again, small thing, but something to think about. So in summary, particularly if you're a limited company owner, I think there's a lot to look at with salary and dividends. And then you've got all these kind of like things around the outside that can just make it quite efficient if you can just make sure you're maximizing all of them. So hopefully that's given you some food for thought. Do go consider it. And as always, massive caveat, it's all dependent on your circumstance. Do seek out some pro advice if you need it. Hopefully this has been good. Please share it with anyone who needs to know this information, and I'll see you in the next one.